Hey guys, today we're talking about prescribed rate loans, and I have none other than wealth and estate planning specialist Adam Buss to chat with us about that really neat thing where you borrow money to either your spouse or your corporation, a prescribed rate loan. Adam, thanks for joining us today.
Thanks, Rob.
Okay, so who would have a prescribed rate loan, and why would you have one?
So prescribed rate loans are usually a matter of trying to transfer income from a higher earning spouse. Somebody's in a higher tax bracket, and maybe spread that to their spouse that has lesser income or no income, to try to spread it out over their tax brackets. And really the whole concept is just to try to minimize taxes for the family. So if you can shift some of that taxable income from one person to another, I mean, you're winning as a family unit.
It's a tax arbitrage situation. So let's say, for example, I'm paying 50% and maybe my wife is paying 20. If we could shift the income over to her, we can even those out at 35 or whatever, something like that.
Yeah, and this is often using non-registered dollars. So clients perhaps have a large amount of non-registered assets that are under one person's name. They will borrow that money, they'll lend that money to their spouse, or maybe they'll lend it to their family trust. And then that trust or spouse now has to pay them the prescribed rate, which today it's at 1%. Fun fact, that's going up to 2% as of July 1st this year. So we have a very limited window that if you want to get this strategy accomplished and lock in that 1% rate. The whole point again, so now that spouse or common law partner, or again, the trust, is going to pay that interest rate on that dollar amount to the lender, which is perhaps their spouse, on an annual basis. So let's use an example, Rob, for you. Okay, so you have $1 million of non-registered assets. You borrow that to your spouse. They owe you 1% per year, so 10 grand a year. And that investment that they're earning, let's say, is getting a 5% rate of return. So that $50,000 of income is now shifted to the lower income, the lower tax bracket spouse, and tax at their marginal tax rate, instead of perhaps tax to the higher income earner who's already paying 50%.
So the key with this deadline, though, as I understand it, July 1st, 2022, if you've lent money to your spouse or to your trust before that, and you've got documentation and you've actually moved the money, you are locked in at 1% on a go-forward basis. Correct?
Yes, as long as it is documented, the assets have switched over before July 1st, you have that rate kind of set in stone. You are locked in for the term of that contract, which could be, a 20-year window. Who knows, right? Unless you decide to refinance it at whatever rate is down the road.
So typically the reason you would do this is to save on tax. So you would want the interest rate to be as low as possible. And the individuals that we are suggesting this solution to, typically we're doing it as a tax savings or tax mitigation tool. So the lower the interest rate is, the better it is for the couples that we work with, or for the individuals with family trusts that we work with. So when the interest rates move to 2% on the prescribed rate loan, it puts a damper on the tax planning ability, because now you're paying double the amount to your spouse in taxes. So the margin of savings on income tax becomes less and less.
That is correct. Yeah. I mean, if you can save an entire percentage point and shift that entire percent to the lower income spouse, I mean, try to lock that in while you can. Doesn't mean the strategy doesn't make sense at 2% for some people, but again, it's less of an arbitrage, as you had mentioned.
Much more efficient at 1% than 2%. Be aware that it's changing on July 1st, 2022. Be aware that in the future, if interest rates change again and the prescribed loan rate changes again, be aware that they will announce a deadline, and you'll have to do this again if it goes from 2 to 3% or whatever that may be. Be aware, we've told you guys here that you could lock in a lower rate at that time as well. And again, these exist to create some tax arbitrage between typically spouses, common law spouses, or between an individual and his or her family trust.
That is correct.
You lend money, you get the lower tax bracket individual paying the income, and you get the higher tax bracket individual paying the borrowing costs. So it becomes a win-win situation for the tax planning ability. Anything else, Adam?
We'll discuss it with your advisor, make sure it's the right fit for you. Discuss it with your tax professional or your legal advisor, whoever's part of your overall team. Big part of this comes down to planning. We want to make sure that we're giving you the right advice for your particular situation and that this is the right fit. And of course, that we're doing it for the right dollar amount that actually makes an impact to your family's tax situation.
If you'd like to chat about this or anything else with respect to planning or a prescribed rate loan, don't hesitate to go to www.speaktorob.com. We'd love to book a no obligation consultation with you. To chat about that, Adam Buss, thank you so much. I'm Rob Tetrault. I will see you in the next video.